everyone. A warm welcome to the 19th episode of the webinar series brought to you by Steelmint Events. I'm Shreya Divakran, the Assistant Program Manager for Steelmint Events team and your host for today. First and foremost, I would like to thank everyone here for joining us today for this session. One day I came across this article which showed the surprising rise of China's economic growth. The steel productions are also expected to cross 1 billion tons. After careful consideration, we decided to explore our webinar platform to create a panel discussion where we are hoping to get some insights on how Chinese steel production and demand managed to stay ahead during these unprecedented times when the rest of the world is still recovering from the COVID-19 hit. Coronavirus pandemic has unleashed a series of unprecedented events affecting every industry. Staying on top of trends and accurate analysis is paramount now more than ever to manage uncertainty, change, and continuously adapt to new and evolving market conditions. We see that China's Q2 GDP grew by 3.2%, beating the expectations. You can see that the rest of the countries here have negative growth and significant fall in the GDP in Q2 apart from China. Amid the growing push for decoupling and economic distancing, the changing relationship between China and the rest of the world will influence competition and opportunities in the steel market. Continuous monitoring for emerging signs of a possible new world order post-COVID-19 crisis is a must for aspiring businesses and their astute leaders seeking to find successes in the now changing iron and steel market landscape. We also see that China's steel output is set to rise by 4%, rupturing 1 billion tons for the first time. According to the July's custom data, China's iron ore imports have surged up to 24%, making it a record from a year earlier, which were marked at 112.65 million tons. This is driven by shipments from miners and buoyant demand as the economy bounced back after the disruptions from the coronavirus pandemic. China became the net importer after 11 years. Their imports were much higher than their exports. You can see how there's an increase in the trend for their steel imports. The theme of this webinar focuses heavily on how China's steel production is set to hit 1 billion tons in 2020. That is the first time ever. We are hoping today's session would shed some light on what is driving it and how long will it continue? How long will it sustain? Steelmint Events is pleased to host a set of influencers in the market to enlighten us on this scenario and learn the various new opportunities this current normal presents. Our esteemed speakers for today's panel discussion are Mr. Liu Biao, Deputy Director Marketing, China Iron and Steel Association, CISA, China. Ms. Hongmei Li, Head of Content for My Steel Global, Singapore. Mr. Andrew Glass, Founder and Managing Director of Avatar Commodities, he's from Singapore. Ms. Madhumita Mukherjee, Editor for Steel 360 magazine, publishing by Steelmint, India. Ms. Victoria Zhou, English Editor for My Steel Global, China. Just a little housekeeping before we get started. We have enabled our Q&A feature, so we will try to take up as many questions as possible, depending on the time limit, of course. So feel free to just pop your questions up there and do make sure to share your name and company name as well. We'll also make sure that your questions are being shared by our panelists. So if they would feel like getting back to you with their answers, they would reach out to you. Also, if you do miss anything during our session today, don't worry, you can access the on-demand recording when it's available on our Steelmint Events YouTube channel. Now, without further ado, we will turn over the time to our first speaker today. We are joined by Mr. Liu Biao, the Deputy Director for Marketing from China Iron and Steel Association, CISA, China. Mr. Liu has many years of work experience in the steel industry with special focus on the steel supply and demand dynamics, as well as the downstream development for a long time. I'd like to welcome Mr. Biao and thank him for joining us today. Mr. Biao, we would like to open our floor to you now so that you can share a brief on how the Chinese steel market is faring at the moment. Mr. Biao, over to you.
Okay, thank you. Hello, everyone. It's my pleasure to share my points in this meeting and communicate with everyone. As we all know that this is a special year, and we know that the COVID-19 had a big effect on world economy, and also it affected on China's economy. In the first quarter, we can see that China's GDP dropped by 6.8%, and this is a big drop. And we can say that this is the first drop from since 1917. And the Chinese government controlled the virus very well. And in the second quarter, the GDP rose by 3.2%. So we can say in the first half of this year, the GDP dropped down by 1.6%. And the IMF also forecasted that in this year, China's GDP will rise by 1%. And many people say that the number will be higher, and some people may say that the GDP will rise by 2% or 3%. So that means that China's GDP or China's economy will perform well. So at the same time, we can see that the world economy was affected seriously by the COVID-19, and many countries' GDP will drop down sharply. So the difference between China and the world, also reflected on the steel market. So we can see that in the first 7 months of this year, China's crude steel output rose by 2.8%, and but we can see that in the first quarter of this year, China's steel production kept stable, and there is a little effect on the production. So especially in the recent months, maybe in June, the crude steel output reached a peak level. Is about 3.05 million tons per day. So it's a very, very high level. Also, we can see that the China's crude steel output came very high level. The big driver is from the huge demand. And in the first quarter, we can see that the steel demand dropped sharply. We think that the demand dropped by 30% in quarter one, and after that, China's steel demand rise quickly, especially in construction. In quarter one, many construction projects were delayed, and after March, and many projects were started. In real estate, the investment were dropped by 7.7% in quarter one, and the number was 3.4% in the first 7 months, and the new starts dropped by 27% in quarter one, and the number narrowed to 4.5%. And also in the infrastructure, we can see that the biggest driver is from infrastructure. In quarter one, the investment of infrastructure were dropped by 20%, and in the first 7 months, the infrastructure investment narrowed to 1%. So I think that the number will be 10 to positive growth in August. So we can see that why the infrastructure rised quickly. So we can see that China's monetary easing policy have provided maybe in the investment in railway and roads and waterways rise quickly, especially in July. The rate was over 20%, and in machinery industry, we can see that in the quarter one, the 120 key machinery products, only 5 products, and in the first 7 months, and they were 36 products grow up. So especially in June and in July, they were 75 products grow up. And in automobile, we can see that in the first 3 months, the output dropped by 45%. It's a big drop, and in the first 7 months, the output dropped by 12%. Especially in June and in July, the output rose by over 20%. So it's a big drop. It's a big rise. And in shipbuilding industry, in the first 7 months, ship deliveries dropped by 9%, and the new orders dropped by 5%, and the orders in hand dropped by 8%. So orders in hand reached the noise level in the last 10 years. So we can see that in the first quarter, crude steel production kept stable, and steel demand shut down in February. So in quarter one, there were huge inventory, but after April, with the steel demand rising quickly, the steel inventory dropped down quickly, and now the inventory was still higher than the period of last year. And we can see in China's steel import and export this year, we can see that in the first 7 months, China's steel export dropped by 18%, and the imports rose by 49%. It's a very, very high rise. And we can also see that 2 obvious figures. The first one is China's steel import price was lower than the steel export price. And the second is that China's crude steel imports was higher than steel exports. So we also have some forecast. First, we focused on that China's crude steel output will be rise by 3% in this year, and the steel demand, WSA forecast that China's steel demand will rise by 1%, but I think that the number will be 2% or maybe 3%, and the steel demand in the second half year will be higher than the first half year, and also it will be higher than the same period of last year. But in the quarter four, we can see that the steel demand rise rate will be dropped down, and it will lower than the rate in quarter two. And I think that the steel export will be kept stable, and the steel import will drop down, and also the steel inventory will still higher than last year in the remaining 5 months. Okay, thank you. That's my point.
Thank you, Mr. Biao. That was very well presented. Next up, we have Ms. Hongwei Lee, Head of Content for MySteel Global. Hongwei is responsible for the English editorial of MySteel. Based in Singapore, she manages a team of 11 market analysts in Shanghai who benefit from the extensive data available. She's been covering steel and non-ferrous metals news and pricing since 2004. Hongwei has previously worked for Platts Metals and Steel News editorial for 6 years, Fast Markets as the Asian senior correspondent for 2 years, and senior correspondent for Metal Bulletin for 5 years. Thank you, Hongwei, for joining us today. Hongwei, we would like to hear from you on how China's economy has been surviving amidst COVID in 2020. Hongwei, could you start your presentation?
Yeah, sure. Thank you everyone for having me. Really an honor to present at the Steel Win webinar again. And it's very interesting time. I think a few months ago, actually, China just restarted the economy and everything. But nowadays, looking at China has been a net importer of many of the products. I think now you can see my screen clearly. Great. And then, so today's topic actually will be talking about China's macroeconomic performance so far in 2020. And miraculously, a lot of numbers I mentioned here will be matching or complementary to what Mr. Liu just presented. And then I will just make it quick. But then I want to highlight some of the sectors I would think will be very important to the market as well as to the audience. So very brief introduction of my company, Shanghai Ganglian or MySteel. I'm working for MySteel Global. Basically, I'm located in Singapore. MySteel Global is a MySteel's overseas business. The office represent our office in Singapore. 2017. And now we are running both English and Chinese news websites. The Chinese one is mysteel.com. The English one is mysteel.net. And then we are basically covering the non-ferrous market, as well as for my headquarters, they cover the agriculture, energy, petrochemical products as well. And this is just a very brief introduction because just in case you didn't know what MySteel is all about. But if you want to know more, just approach me. I will do more sharing. And then disclaimer. So whatever I share here is basically personal observation and some personal opinions about the market. Three topics today. First of all is about China's macroeconomic performance until July, because July is the latest number we have. In a couple of days, we will be having August numbers, but for the time being, just July. I do have a couple of slides actually updated based on the import and export numbers coming from China's Customs Office. And the second one will be talking about COVID-19 on China's economy and efforts for the rest of the year, not only from the government as well as from the steel industry. And the last part actually will be talking about how is China's steel industry faring among the difficult times. So just now, actually, Mr. Liu mentioned a couple of things. Here are just normally the few factors I will be looking at whenever I check out China's economic performance. If you're looking at FAI, which is fixed asset investment, it's still year-on-year comparison by the end of July, it still declined. But the decline actually narrowed from the first quarter or even for the past few months, which means that the overall situation has been improving. And property market is just one of the FAI sector, but it's very important as well because the property market actually supporting the China steel demand and consumption, long as well as a flat steel. So if you're looking at FAI, it's already back to the positive zone, 4.1% year-on-year increase until 7. But if you're looking at the property sales, it's still a decline, which means that the market, especially for the consumers, they are still very cautious in purchasing the properties. A couple of reasons over there, because the economy is uncertain, some people are losing jobs, so they're very careful with their money in the pocket. Land lease minus 1%, even though it's a decline, but compared with last year, the 11.4% decline, it shows that the property market, the land lease actually will be telling you whether the Chinese property developers are getting the land from the government for new project. So this part will be showing that, the situation is not bad at all. The second part, it will be talking about, the foreign trade, as again, Mr. Liu mentioned about imports and exports and steel, about the steel imports and exports. The first one actually I want to share is overall China's foreign trade performance. So if you're looking at imports and exports, exports actually back to positive. So if you're wondering, whether the US-China trade friction affecting China or not, I would say no. But you'll notice that in the following, I just highlight a couple of things. ASEAN nowadays is China's first trade partner. So even up to now, the foreign trade is still a positive 7% gain. And EU, the European Union, also 1.4%. Whereas if you look at the US and Japan, also among the top trade partners of China, the numbers are not really so rosy. It is actually negative numbers. Several sectors I want to highlight as well. First of all, I want to highlight machinery, electrical and electronic exports, which actually is one of the major consumers of the Chinese steel products as well. Looking at the numbers, actually is a year-on-year 2.1% growth. This is mainly just about exports because China do not import much. And another thing I want to mention is about privately owned firms. So they are actually the majority contributor to China's foreign trade. And then normally they will be accounting about less than 50%, but normally it's about 45, 46. So the proportion actually has been safeguarded. And also year-on-year comparison is 8.5% growth as well, which means that in general, China's foreign trade environment has not been changed, has not been affected that much. That is what I'm trying to say. But of course, if you do the year-on-year comparison, you'll be able to see that, even for all the positive numbers, the growth was not really as much as 2018. So, not affected, zero impact, no, yes, there is, but then the impact is not as dramatic. Another thing I want to highlight here is about the physical economy and efforts for the rest of 2020. So in general, I share, what is happening with, the overall economy sector. I didn't include the steel imports and export numbers because Mr. Liu just now already mentioned. China was a steel importer, net importer for July. not only actually for steel. I cover the other markets as well, like molybdenum. One of the raw material for stainless making. And then I talked to my market source. Market source is telling me that, for this year, China has been a sole buyer of a lot of products. So not surprising, I think whichever market, building market, HRC market, you will be very happy for the first half, because China has been purchasing quite a lot to cushion the blow. At least it's not really as bad as expected. So for the rest of the year, I would say that, the physical economy, especially the industrial sector, will be continuing growing and recovering. And this will be the strategy for 2020. Why is that? Because I think just now Mr. Liu mentioned that, the GDP, people are looking at positive numbers. It has to be a positive number for 2020. 2020 is a year of milestone for China's economic performance. China marked 2020 as a year for the country to go into a well-off society. So, being qualified as a well-off society, you need to have a GDP positive number for this particular year. Consumption powers, especially for the individual consumption or the consumers, actually has been compromised. A couple of things, very similar to the property market, as I mentioned, people has been quite careful. Because even though nowadays seemingly China's economy has been doing well, but there is always a kind of uncertainties lurking behind. And then you are trying to be careful with the money in your hand. And also you will be realized that some small and sized enterprises actually really closed down. I got friends like running her own PR company has to be shut down as well. So unemployment rate, definitely, one of the I believe the challenges for the Chinese government will be providing enough job opportunities, not only for the college graduates, but as well as those people that getting redundant or lay off to find new jobs as well. Another thing is catering, hospitality, like hotels, accommodation, tourism spots. Because of the COVID-19 outside China is still very much spreading widely. And a lot of countries are still fighting fiercely against the pandemic. So that's why, the international flight, a lot of international flight have been canceled. So that is hurting China's tourism industry as well. And another thing, I think, for the short term, I think China will slow down the pace, because for the past couple of years, China has been trying to shift the economic model from heavy industry focus to consumption oriented. But I think for this year, from what we have experienced in the past 7-8 months, you can tell the government has been spending heavily into the infrastructure projects in order to rescue the economy. It's a similar situation for the other countries as well. But it's just like, China itself, the market is huge. So the domestic market will be able to help to absorb a lot of output, whether it's steel, whether it's machinery, whether it's like electrical home appliances, whereas the other countries may not be having the bandwidth. That's why in comparison, China's GDP as well, the overall economy has been performing rather well. Here is about the steel industry in particular. I actually have been trying to keep my presentation very short, just highlight a few things. Many of the numbers Mr. Liu have already mentioning, so I'm not going to go into it. A couple of things I want to highlight. Steel output, yes, it's still positive growth, but compared with last year, the rate actually declined quite a bit. And if you look at exports, exports has not been surprising, because exports has been declining since 2016. And last year is back to single digit number, but this year is come back to the double digit number. Whereas if you're looking at imports, especially for billet and HRC, China imported quite a bit. I know Japan, India, I even got other country and my contacts from other countries asking me about what is China's import prices nowadays. So it shows that China has been importing quite a bit. Iron ore import as well, 11% increase. But here I want to highlight is that according to China's official numbers, unit price in RMB until August is still declined by 0.2%, which means that until August, whatever landed at China, the iron ore imported, they are still quite reasonable priced. That's the thing I want to highlight in this particular slide. Just now, Mr. Liu mentioned about the auto industry as well. I will not go into the auto industry. I will just share with you the numbers, just in case you're interested in knowing the numbers. But what I want to highlight here is about excavator. Excavator is one of the heavy machinery, and which is closely linked to mining projects, construction industry as well. So if you look at the numbers, basically it's about 30% in general. Total sales is about 30% year-on-year increase. What is interesting, I really would like to bring everyone's attention to the last two parts. Domestic sales increased almost by the same or higher than average by about 30%. But if you look at exports, it increased, but not as much. So last year, actually exports grew faster than domestic, whereas this year they reversed. So the thing is telling us that domestic demand has been, rather robust compared with the overseas market. A couple of reasons I think is rather obvious, right? Overseas economy are not doing as well, whereas China has been putting a lot of money in infrastructure construction. So that's why the domestic sales of excavators has been growing faster than export market. So this actually, I find it very, very interesting, a lot of numbers, but then if you compare the numbers, compare the trend, actually telling you a different story. Here's a bit of electrical home appliances. Why I'm going to mention this, because China actually exporting quite a bit of home appliances. And the good thing is, the good thing or the bad thing, the good thing is that TV actually back to a positive zone, but that is not the majority, the major, still consumer. But if you look at refrigerator, air conditioner, washing machine, the steel consumption will be more from those sectors, but sadly, they're still in the negative zone so far until July. What will be the steel industry been doing? Basically, I always telling my contacts for this year, 2020, I call it a policy year, which means that the government has been putting a lot of efforts to rescue the economy, to make sure that it will be back to positive from negative. And then because of the government policy, there is a consistency, a sustainability. So for the rest of 2020, I believe all the policies will stay, which means that, in general, China's steel demand will be stable, will be positive. And then at the same time, you'll be surprised to see that even though 2020 is not really a robust year for the steel industry, but whatever they have been doing for the past couple of years, they are still doing. Like M&As, mergers and acquisitions, they're still doing. So a while ago, we did a story about Baowu. Baowu is already number one, almost matching ArcelorMittal. Last year, I think it's only a couple of million tons of difference in output. This year, Baowu actually is in a middle of discussion with Tisco, Taiyuan Iron Steel. This is one of the major China stainless producers. They are talking about mergers and acquisitions and pollution control. If you have been watching China's market closely, you'll notice that especially in Tangshan, they have been sending out frequent commands to the local steel mills, including re-rollers, just to cut off or kind of idle the facilities just for pollution control. So it's still very much ongoing. And relocation is another thing, because Chinese government has been asking the steel mills to just relocate the steel capacity to coastal areas. It's still happening. So nothing has been, maybe at a slower pace, but everything is still happening. Another thing I want to highlight, I think many of you may be in the iron ore industry, you'll be very interesting to know that China, a lot of miners are trying to bring in their iron ore supply, not only the quantity, but as well the relationship and the service closer to home, which home means that to China. So like, the Valley, as well, Rio Tinto set up the blending services recently in China, Zhoushan, and also more and more deals are done in yuan price deals on the agreement or on the negotiation with the Chinese steel mills. Those are the subtle changes in the iron ore market, but that is telling a very interesting story, which means that overseas miners are paying closer attention to the Chinese market needs. And which means that China will remain the primary targeted market for the top 4, top 5 miners. And another thing is, I think this will be more like the long-term strategy, sustainability in expanding to non-steel sectors. not be surprised if some of the Chinese steel mills go into non-steel related sectors, because steel, it will be durable, it will be sustainable, but there will be other materials that can be substituting steel and making it longer lasting and more cost effective in the future. So the Chinese steel mills are looking at other markets as well, and also carbon neutral. A lot of overseas market talking about carbon neutral. China is far from it, but China is going toward that direction as well. Those are the few things I want to share. The last one is just my contact details if you want to know. And then we have the LinkedIn free access. You can check out stories. The website is just a screenshot of what we're providing. Yeah, that's all. Thank you very much.
Thank you, Hong Wei.
Yeah.
Moving on, we will call upon our next speaker. I would like to introduce our next panelist, that is Ms. Madhumita Mukherjee. She's the editor for Steel 360 India. Steel 360 is a magazine published by Steelman, and Ms. Mukherjee has more than 25 years of journalistic experience, having worked with some of the leading dailies in India. She has covered a lot of government beats, including steel, coal, and allied sectors, and has been pursuing a career exclusively in steel journalism since 2013. She was also awarded a Certificate of Merit in the category Excellence in Steel Journalism by the Indian Steel Association in November 2019. She had previously been in charge of content and was the news editor for 2 magazines, Steel Insights and Coal Insights, published out of Kolkata, India. She took over as the editor of Steel 360, the magazine for our steel sector, and is published by Steelman in May 2019. And with this introduction, I'm passing on the floor to Ms. Madhumita Mukherjee to share her views on the Indian steel exports market and provide her takeaways from the industry. Madhumita, over to you.
A very good afternoon to you, to my esteemed panelists, the attendees, and Steel Mint events for giving me the opportunity to speak at this forum. I join you from Kolkata, India on this partly cloudy and partly sunny day. We are in the midst of the monsoon or the rainy season in India, when domestic steel demand generally stays subdued, especially for long products, since construction work comes to a standstill. But this year, thanks to COVID-19, all the usual trends have gone somewhat haywire. And as we all know, it was exports that kept the steel mills' cash registers jangling during the lockdown, since domestic demand had reduced to almost nil. And when we come to the topic of steel exports, China's undeniable role comes into play. China did open up a golden opportunity for India's steel mills. But before we discuss India's export trends and how volumes escalated from May till July this year, let us delve a little into the latter part of 2019. But before that, I would like to share one slide with you all. India's steel exports. Exports rose in October-December 2019 due to high inventory levels held by the steel mills in India on account of a dull domestic demand scenario. Our data shows that India's steel exports range from 0.20 million tons to 1.33 million tons over August to December 2019. But January till March, at least till the 3rd week before the lockdown was announced, saw exports weakening by almost 27% quarter on quarter because of improved domestic demand and consequent restocking by traders. In end February, early March this year, I had met some steel industry officials, who had sounded very upbeat. The demand was showing an uptrend and the domestic market was looking up. Then the lockdown happened from the 3rd week of March. If we see the figures, April kind of absorbed the shock of the lockdown at around 0.77 million tons. But from May, there was a sharp upturn in export volumes to 2.32 million tons, which was an over 200% rise month on month over April. In June, volumes remained high at 2.27 million tons, but July saw a record upsurge to 2.44 million tons. On a cumulative basis from January till July, export volumes had touched 10.60 million tons against 5.76 million tons in the same 7 months of 2019, up 84%, driven mainly by the volumes triggered in those 3 months of May, June, and July. Overall, from April till July 2020, steel exports touched 7.8 million tons against 2.89 million tons in the same first 4 months of 2019-20, a whopping 169 rise year on year. From April to June, there had also been an exponential jump in export volumes, and around 60 to 65% of this quantum had been going into China. April and May were the 2 months when the mills were struggling to survive. Domestic demand was nil due to the lockdown. No other market other than China showed normal demand levels at that juncture. Whether in South Asia, Middle East, or Europe, which are usually the prime destinations of steel from India, these markets were in lockdown. The only option thus was China, and to an extent, Vietnam, Nepal, and a few other countries. So export volumes became the bread and butter of the mills. Most of the mills were able to read the situation well. A leading integrated flat steel producer, for instance, had booked orders for hot rolled coils from April end till mid-June and up to August end. It had anticipated that the lockdown would extend further and the migrant labor issue would also persist for some time, and nor did it expect domestic demand to revive immediately. The mill had covered itself from June till August. This particular mill usually exports not more than 16 to 17% of its production, but in April, almost 100% of its production went into exports. In May, the figure reduced to 80%, and in June, with the domestic market opening up, overseas sales amounted to 30 to 35%. As per the company's source, in July and August, they expected export volumes to return to their normal levels, to hover around 20% of the total output. Another leading integrated steel producer in the private sector shipped almost 25% of its production to China in July. In April and May, exports comprised 50 to 70% of its total sales. Post mid-June, its production was impacted because of the pandemic. Therefore, it had some spillover from the previous month. The quantity that was supposed to be exported out in June got shipped in July. It was learned that this mill had been ready to book for August, but the quantities had not been that large. The volumes, in fact, have come down to their usual levels of 2 to 3 lakh tons, covering semis, longs, and flats. It is now going to slow down further in terms of exports because the domestic market is improving, as well as prices. In fact, this particular steel major aims to reduce its exports percentage to 15% by the end of financial year 2021. The Steel Authority of India, a PSU, in a con call had said that its FY21 target in terms of total sales was 15 million tons, of which exports would comprise 2.4 million tons. In fact, it seems SAIL had never exported such quantities in the past and had even started exporting HRCs, whereas earlier its exported items were only semis, billets, and blooms. Actually, nobody had anticipated what would have happened in the next 3 months from the lockdown. Most players had expected the lockdown to be for a short duration. Till mid-March, many suppliers had even felt they should stock the material beforehand in case the lockdown was implemented so that they could sell once it eased. Now let us come to the importing countries. From January till July, imports amounted to almost 10.60 million tons, and India's main exporting countries were led by China, followed by Vietnam, Nepal, UAE, and others. China's imports from India, as per our data, amounted to 3.43 million tons over January to July 2020, followed by Vietnam at 1.97 million tons, 0.66 million tons to Nepal, 0.53 million tons to the UAE, and 3.43 million tons to other countries. China typically used to export around 5 million tons a month and would also import from Japan and South Korea, the dominant trading partners. Now, due to the slowdown, exports from these countries were affected And there was a gap in the Chinese market which could be exploited by the Indian mills, and which they did. Domestic demand in China picked up really fast after the lockdown, and items that are exported are finished flats, finished longs, and semis or billets. We have also noticed that it was mainly finished flats which had found the most takers in India's export markets. Over May to July, finished flats exports were at 3.71 million tons, whereas finished longs were at 0.45 million tons, and billets were at a substantial 2.86 million tons. Now, we at our end realize there are several reasons why China opened up a Pandora's box for India's steel mills, especially the integrated ones. And I hope my panelists would also agree with me. First, many mills in China had put their blast furnaces down, which were taking time to ramp up. Secondly, India's imports were cheaper compared to domestic steel. Thirdly, the Chinese mills were showing a propensity to preserve precious raw materials like coal and iron ore. Steel prices rose. Fourth, and important enough, Tangshan, the steel hub in northern China, had implemented a fresh round of 1.6 million tons production cuts in March across 20 mills, due to which there was a scarcity in finished and semis items. There had been a lockdown in some of the provinces in China, but as soon as this eased, there was a perceptible shortage of material against a backdrop where the country was trying to normalize the economy with a sharp infrastructure and construction push. And another interesting factor was that India was offering billets and HRCs cheap. So Chinese players adopted a strategy of purchasing from India and then waiting to resell the material at high prices at an opportune time to earn a good profit margin. A change, but now we see a perceptible change in the trend. The Indian steel industry is bracing for a change where exports are concerned, and interestingly, mills are delaying their shipments, we are told. Some large private and public sector mills have delayed their export dispatches by around a month. All the bookings being deferred, it seems, were done in the month of June for July and August shipments. But now we are told mills have asked for July shipments to be shifted to August shipments to be pushed back to September, and September's to be deferred to October. And the only reason behind this loss in appetite for exports lies in increased domestic demand. India's steel production, consumption, and exports. India usually consumes around 25 million tons of steel in a quarter. But before that, let me show you this particular slide. India's steel industry scenario, FY20 and 21. We see that consumption till August have been at 25 million tons. Last year, the country consumed over 100 million tons. All the steel consuming sectors are looking up now. Auto, which had declined by 75% in the April to June quarter compared to the same quarter last fiscal, is trying to come back. Construction, which had been completely stalled, will resume post-monsoon. That is expected. Towards the end of the year, a lot of infra and construction projects get a push, and there is a pressure of project closure, etc. And that is good news, because construction is the biggest steel consumer at more than 50% share at a conservative estimate. If we see this particular slide, we note that domestic demand is looking to touch January levels of around 8 million tons, and September onwards would perhaps be better. Mills have also started operating at above 90% levels in a bid to cater to this rising domestic demand. Now, we come to prices. Prices have gone up twice in the last 1 month in the domestic market, making it more lucrative to sell in the domestic market. The mills are getting better prices compared to what they were fetching through exports. In fact, if mills were earning, say, rupees 4,000 to 5,000 per ton more in the domestic market last month, this price differential has gone up to around 6,500 to 7,000 per ton. Let us look at India's domestic HRC prices versus export offers. Domestic HRC prices have climbed to above rupees 38,000 per ton in August from a low of rupees 36,000 per ton in June, and domestic rebar prices are cruising at a little below 38,000 per ton from a low of rupees 35,500 per ton in July. In dollar terms, from a low of $4.75 per ton FOB in June, these are hovering at around over $5.50 FOB levels. Export prices were low in April at a little over $3.75 per ton FOB, but have risen to almost $5.20 per ton. July FOB prices were around $4.30 per ton FOB. But then, as already mentioned, exports do not look so attractive going forward because, one, some of the export orders have been booked at, say, $500 plus prices, but which will need to be serviced in September. Secondly, the scenario is not such that mills will be able to sell across buyers. On the other hand, a source told me recently that if mills can sell at, say, rupees 38,500 per ton delivered to all the buyers in the domestic market, and after deducting around, say, rupees 2,500 per ton in terms of freight rates in the domestic sector, if the mills sell at even rupees 34,000 to 35,000 per ton to some of their best consumers, this amount would be their net realization ex plant. Now, this person also said that the April-June quarter was really bad in terms of realizations, but volumes were high in terms of exports, as we saw. Export prices hovered around 430, 440 USD CFR in early mid-July. So let the mills make some money now. Thirdly, mills are delaying exports to use their resources to manufacture for the domestic market, and this can make a difference to their second quarter earnings. They can average it out and get better price realizations. The Q2 results can look brighter. Fourth, HRC sourcing countries like Korea, Japan, and others were all offering at USD 500 or more FOB. Chinese mills were offering at USD 520 FOB and above in August. Now these offers have climbed to around, $520, 540 FOB levels. Steel players in these countries can afford to, hike their export prices because their domestic markets are looking up, putting them in a position to raise their export prices. India is no exception. Indian steelmakers are aware that buyers with whom they have export contracts will not cancel the orders or back out, even if the shipments are delayed, because they know the buyers cannot get the material at the prices at which they had concluded these deals earlier, at around 430 per ton FOB. India's steel exports product-wise. Now, billets. Billets exports had crossed 1 million tons in July, an all-time high, against 0.82 million tons in June, up around 28% month-on-month. May had been a very good month for billets exports too, touching 0.99 million tons, since the country then was still in the throes of the lockdown and domestic demand was almost at around nil then. But subsequently, the industry had been bracing for a lean domestic demand period in July and August, both months being part of the monsoon season, and this year being made worse by the lockdown. Hence, the mills had pre-planned to book large volumes of billets export consignments in the rainy season. So the large consignments of billets were really no surprise. But henceforth, the industry is not likely to see such high billets exports. In fact, there is no further allocation in billets from the large mills, I believe. In fact, a source told me there are no exports allocation for billets from September till November. Look at finished longs. Where finished longs were concerned, we noticed that exports of these were down by around 35% to 0.13 million tons in July, against 0.20 million tons in the previous month, against a backdrop of elevated exports overall. Now, the reason for this is demand for rebars is increasing in the domestic market. Longs comprise mainly of wire rods and TMT bars, and whatever is manufactured at home is sold to the domestic market, leaving little else for exports. The scenario is similar with TMTs. Now, there's a government policy which can also have an impact on exports. Importantly, an impending policy decision could act as a major disincentive for exports. The Indian government had decided to slash export rebates, a move that can raise prices for steel shipped out of India. A final decision on the matter is still under discussion, but the rebate an exporter receives on steel exports would be cut from the current 2.5 to 3% per transaction to 1.5 per deal. Outlook. So in August, shipment volumes are expected to be at a modest 1.65 million tons, we are told. Going forward, export volumes are likely to come down even further to 1.3 to 1.4 million tons in September, as per steel mill sources. Export prices in September, October are likely to remain elevated, but whether deals will be struck at these levels will remain to be seen. There is a bit of silence in Southeast Asian markets as well. Buyers are quiet, yet mills prices are hovering around $5.20, $5.40 FOB. Export prices are up because domestic markets across South Asian economies, as I have already mentioned, like Thailand, Indonesia, the Philippines, are looking up, allowing these economies to up their export prices. Such a scenario bodes well for Indian steel makers, opening up homegrown demand opportunities. Thus exports do look less attractive under such circumstances. China too is lessening imports. Again, the same reason, Indian domestic prices have gone up and accordingly export prices as well. The gap between Chinese local and arrival prices from India for buyers in China have narrowed. Yes, there is less interest for Indian materials. Today, Chinese domestic prices are equivalent to $5.40, $5.50 CFR levels. Indian export prices are also at similar levels if offered to China. Previously, Chinese domestic prices were at $450 CFR levels, whereas Indian offers were at $430, $440 levels. So no point in buying from India as Indian HRC prices slap an additional 3% import duty in China. Well, that's all I have to say. Viewers, if you have any questions, feel free to ask me later in the webinar. Now over to you, Shreya. Thank you so much.
So for our next speaker, we are joined by Ms. Victoria Zhao, the English editor for MySteel Global from China. Victoria joined MySteel in July 2016 as an assistant analyst focusing on the iron ore market, and then later joined MySteel Global as a member of English editorial in September 2017. With the interest in the primary market coverage of China's iron ore market, including both domestic and seaborne markets, covering the prices, inventories, capacity utilization, Chinese steel mills' consumption pattern, and China's industrial policies. Thank you, Victoria, for joining us today. Victoria, I'm passing on the floor to you so that you can share your presentation with us on the Chinese steel mills iron ore procurement tactics on high prices. Victoria, over to you.
Yeah.
Yes.
Okay. Let me share my screen.
Can you make it full screen?
Yeah. Wait a minute. Okay. Thanks for inviting me to share something about Chinese iron ore market. The sharing below is my personal opinion, and welcome you to contact me for any ideas about the market after the presentation. My sharing will include 6 parts. First, let's have a review of imported iron ore price movement so far this year. Okay, the price movement can be divided into 2 phases. It first fell immediately after, first, it fell immediately after the prolonged Chinese New Year holiday because of the unfortunate outbreak of COVID-19 in late January. And the price constantly fluctuated and depressed until the end of April. But the prices were still very resilient in the first quarter, because as we know, China is the world's top steel producing country with over 50% of the market share, and its domestic steel mills with around 90% of the steel making capacity, while blast furnaces have kept operating throughout all the chaos, as they could not afford to switch off their big-sized furnaces. So such kind of conditions lend support to the iron ore during the first quarter. And then starting May, prices went into an uptrend and have sold to multi-years high. This kind of surge was contributed by both supply and demand side, which later I will mention. So if you say the index, my steel CDEX was over 130 per tons on September the 3rd, which is a new high since January 2014. And the port DAX was at 971 yuan per ton in late August, which is also a new high since April 2013. So now let's talk about Chinese steel mills' performance and iron ore demand. Chinese steel output growth did subside remarkably amid the battle against the COVID-19 in the first quarter, but then it recovered drastically starting the second quarter and even recorded new highs. If you pay attention to the daily crude steel output, you can see that the volume was at new highs in May and June. And the blast furnace utilization rate also recovered from the lowest point around 80% in mid-March to hit a two-year new high of around 95% in the mid-August. So such kind of fast recovery in blast furnace capacity utilization and high steel output from the second quarter have been providing constant support to the iron ore prices and the demand among Chinese steel mills. This is the demand side. And for the iron ore supply side, in fact, iron ore shipments from Australia and Brazil have been spiraling up since the second quarter with more cooperative weather. And so far, the impact of the coronavirus on iron ore shipment was not, has been minimal, even though the concerns is loitering because of the coronavirus outbreak in Brazil. And you can see that the top 4 iron ore miners shipments stayed low in the first quarter. Because normally this season has rainfalls and hurricanes for Brazil and Australia, which will affect the shipments to some extent. But Vale's shipment seems to have been recovering starting the second quarter from its catastrophic dam collapse in January 2019. So at present, Vale still targets to finish its iron ore output guidance for 2020, which is around 310 to 330 million tons. But considering its first half year's performance was not so good, it may need to beef up the efforts in the second half year. And beside all of it, the high iron ore prices did encourage more non-mainstream overseas supplies into China. You can see that there will be more exports from India, Ukraine, Canada, and Russia in this year. That's for the second half year, MySteel estimates a higher supplies in global iron ore market, in the global iron market. Then. But if you observe the iron ore stocks at the Chinese 45 ports, you would say that the volume had been declining for most of the time of the first half year. And the volume even fell to about 106 million tons over June the 12th to 18th, which is a new low since October 2016. This is because the demand from the Chinese steel mills have been rather robust and sound. And recently, you can see that the volume has been gradually recovering, but it is still at a relatively low level. And also, you can see that the Australian iron ore fine stocks are still declining. In fact, it has been declined for 6 weeks by last week, which is also strongly supporting the iron ore prices. And I have to mention that in August, the congestions at some Chinese steel ports are really serious. And this might be a reason for such kind of decline in the Australian iron ore stocks. And other than imported iron ore supplies, we can also say that China's domestic iron ore concentrate supply has also increased when the overall iron ore prices are hovering at high levels. This shows that the Chinese iron ore miners are trying to produce more on solid demand and healthy margins. And one more thing I need to spell out is that domestic iron ore concentrates can be used for both pelletizing and sintering. But for now, the room for further growth in domestic iron ore concentrates output is limited due to the degrading of the deposits. Okay, the last part, I would like to share something about how Chinese steel mills cope with high iron ore prices. When prices of mainstream iron ore brands persist high, Chinese steel mills always fine-tunes the ratios of feedstocks for the highest efficiencies and lowest cost. And for example, recently, the mainstream iron ore fines prices are high. So some steel mills would like to consume slightly more lumps and pellets, which prices are relatively more affordable as a substitute to some sintered ore. Also, when Australian medium to higher grade iron ore fines prices are high, carriages fines mixed with lower grade iron ore fines has also become an alternative for some steel mills. Besides, steel mills are also cautious in taking in iron ore, as they tend to control their iron ore quantities and stocks within a reasonable range rather than stocks a lot of raw materials at a time. So those are all the things I would like to share with you. Thanks for listening. If you have feedbacks or questions, please just feel free to contact me. That's all. Thank you.
Thank you, Victoria. Very well presentation that was presented. With this presentation, I would like to share some of the key highlights from our speakers today. Mr. Liu shared that Chinese steel demand will increase. He thinks that the Chinese steel demand will increase 2 or 3% and will be high in the first half of the year. Steel export will be stable, imports will be dropped down, and inventory will be higher than last year. Hongwei mentioned that China has marked 2020 as the milestone. Steel exports have come back to the double digits. China's steel demand will be stable. Ms. Madhumita shared that in August, for India's shipment volumes are expected to be a modest 1.65 million tons. And going forward, export volumes are likely to come down even further to 1.3 to 1.4 million tons in September, as per steel sources. China too is lessening its imports, again for the same reason. Indian domestic prices have gone up and accordingly export prices as well. So the gap between Chinese local and arrival place from India for buyers in China narrowed, hence less interest for Indian material. Lastly, Victoria mentioned that China's imported iron ore prices are have been fluctuated in Q1 and soared to a multi-year high. The iron ore supply from overseas is also gradually increasing. Before we start the panel discussion, I would like to introduce our next panelist, Mr. Andrew Glass. Mr. Glass is the founder and managing director of Avatar Commodities in Singapore. He is a proven, innovative business leader and builder across a range of disciplines with focuses on commodities. Mr. Glass has a diverse career in international commodities for over 25 years. He has been posted in 4 continents in a variety of disciplines with a range of trading and financial organizations, leading and developing businesses, creating sustainable value in varied products and services. He started Avatar Commodities in 2015, manifesting its philosophy and idea of applying the learnings of agri-commodity trading to bulk commodities and other mining and metals commodities. This concept and opportunity was also captured by Anglo American and their marketing business unit, where Mr. Glass established the ferrous trading desk for Anglo American. Thank you so much, Mr. Glass, for joining us today. To sum up today's speeches and presentations, we would like to hear from you on your thoughts on the risk management in the iron and steel sector, and what do you think are the prospects in terms of hedging and trading? Mr. Glass, could you throw some light on that, please?
Yeah, sure. Thank you. Thank you very much for the opportunity to join you all today, and for working with the other esteemed panelists and Steelmint. Look, I mean, I think that the opportunities at the moment have become put in a spotlight as far as when it comes to risk management. We've had extreme volatility. If we look back, I suppose, to the iron ore markets pre the unfortunate disaster in Brazil, we were pretty much trading at $70 sideways, plus minus a little bit at the 62 Fe product on the SGX. And there was nothing much happening. But when that disaster came, we had an injection of volatility. We went up to around 50% volatility in the 62 contract. We also had similar in the 65 as well, which was recently introduced. And a lot of volatility, obviously, onshore China, mill margins, etc. The interesting thing at the moment, we're down to probably about 40% at the moment in at the money volatility. The skew that we see in the options market, and it's great to be able to look at the math in that market because it gives us an indication of where willing buyer and willing seller are meeting in liquidity. There seems to be a bias towards the market coming off, so there's a lot. The skew is favouring what we call the puts, which is an indication that the market is looking more at the probability that we see a downward movement from here than an up. A lot of banks are coming out now too, and I've been reading a lot of reports from them, basically looking at the market having possibly peaked around the prices they are at the moment. We're about 127 on September today, 122 in October. These prices are significantly good. They're in the top percentiles of prices over the past 10 years. We've also got Cal 21 trading over $100. We've got Cal 22 at around $87 and Cal 23 at $80. Now, those numbers are well beyond the marginal cost of production. If we look at the global marginal cost of production in the iron ore space, again, we're talking on the 62 here, and I'm using the numbers coming out of the SGX, which is probably the most international contract that's traded, US dollars, very robust settlement mechanism, very diverse and liquid contract as well. So very good for managing the risk. The other thing that's been very important too is the proliferation of derivative contracts to allow physical participants to manage their risk. So we've seen the LME even coming out recently with a China steel contract. We've got the SHFE domestically in China with the rebar contract. We've got the DCE with their contracts, physically deliverable. By grades or by brands, which is very important too, because that gives you a floor price to each one of those brands, because if it does drop so low, then you can just effectively sell the DC and deliver against it. There are some issues with managing QP risks that have been a bit of an issue with the lack of liquidity in the DCE and the sequential contracts. But you do have that in the SGX, and a lot of physical participants use that exchange to manage the QP risk, particularly the big traders, because they make the iron ore market, having traded in a lot of different commodity markets, the iron ore market is quite unique in the fact that it is almost permanently backwardated. Not always, but as close as you can get to that. And particularly when the prices are very high. I mean, we see backwardation at the moment. That is where the front month is trading higher than the next month, of close to $4 on the October-November. I don't talk so much about the September because we're already getting close to a third way through settlement of that contract. And with that backwardation and steep, providing a lot of opportunity, a lot of participants in the market to trade there. Hedge funds, for example, now are becoming a lot more active in the space. Iron ore is seen as a proxy for China growth story because of, again, the proliferation of different contracts. We've got freight contracts, which are liquid. You can trade on the SGX. You've got steel contracts, which we just talked about in numerous different exchanges. You also have the coke and coal contracts as well. So you can actually trade the virtual steel margin. Now that's important too, because right now, as we look at China becoming sort of more and more, we always said that China, a table in Beijing, is effectively where prices are determined for iron ore, even if you never touch China, right? So every participant in the value chain, regardless of how big they may be, if they're the big four miners, etc., they don't have as much control as that table in Beijing defining price policy. Using policy, which precipitates price. So if we are all price takers, no matter how big and powerful we are, then the use of derivatives to manage our exposures is extremely important. And to a degree, different participants are more adept at doing that. And this is what we try and do in my company too, is help share the ideas and the knowledge from other commodity markets and try and apply it to this market, and how we can protect both producers, consumers, be they steel mills, be they pellet producers, anywhere through the ecosystem where we've got access to those kind of derivatives. Ideally, you want to align your physical without necessarily having to go to derivatives, but you need all the tools available to you. And that's the beauty of the evolution of this market, particularly over the last 10 years. And it has just continued to evolve into a very good space. And that's also effectively verified by the fact that we now have a lot of hedge funds, like I was mentioning earlier, very interested in participating in this space. They look at the derivatives also as a way of expressing different opinions on equities. We've seen a lot of volatility in the equity prices of the major producers in particular, that are freely traded obviously on exchanges around the world. What I'd like to say though as well is that we've also seen this year a significant change. So we've seen that table in Beijing and that price definition coming from there has become even more important because China has basically gobbled up as much of the iron ore. It's almost a gluttonous appetite. And we've talked about steel too, right? Be it anywhere in the steel complex, be it those FE units, either raw FE units as fines going to China on the seaborne market, or be they actually evolved steel units that are going into China. Their appetite has been absolutely amazing. And frankly, it's saved the producers around the world, because you had Japan, Korea, other Asia, Europe, North America, India, as we're discussing right here as well, central to this conversation, not wanting those FE units to go into their steel mills, right? But China said, I'll take all of that and more. And they've been paying up for it too. So it's not as if they've had to be discounted in there. What I think is going to be very interesting for price moving forward too is how the rest of the world reacts now. So how do they come back? And I think we've got, I mean, we could talk about this stuff for a long time, but we have conversations about globalization and localization. I think Europe is making steps, particularly with the Green Deal that they're pushing now too, looking at hydrogen, for example. Companies like FMG putting a lot of time and effort into hydrogen, so are the other majors. We've seen BHP come out today and talking about their commitment to net zero and how they're going to cut their emissions as much as possible, and even third degree emissions, to work with their customers on reducing emissions. So I think the COVID situation in 2020 is proving to be a big turning point for climate change, for ESG, environment, society and governance, which is the new CSR effectively, the 17 sustainable goals as well, and that's going to impact the pricing and the relationships throughout the global steel supply chain. We will never have green steel. So every time I hear that green and steel put together, it's a bit of an oxymoron, but we can get less damaging steel. And steel is going to be critical. It's critical to humanity. It's critical to our societies. Mining is as well. But we need to do it. We need to evolve it. So I think that we're going to see, I don't think we're going to see China absolutely dominating the FE supply chain by being the producer and exporting around the world. One of the questions I suppose a lot of hedge funds have talked as we've seen this price rising so much is what happens with those FE units? Where are they? Now we've seen car sales, which we've talked about here, machinery sales. They've been stellar in China. They were 300,000 units in February, but they bounced back to over 2 million almost immediately in March and have consistently gone up since then as well, which is I love that point, by the way. Anything on auto, because that is the biggest depreciating asset that someone will fork out for, right? So auto sales anywhere in the world are a great reflection of consumer confidence. Right? I mean, all the other indexes are great, but auto sales is a cracker for looking at what actually is consumer confidence, because you don't buy that depreciating asset at that price unless you're confident in the future. And that numbers we've seen out of China are just fantastic. What the other questions are is all of this FE, this gluttonous appetite for FE going into China in the form of seaborne has largely, I believe, been driven, particularly in Q1 and Q2 and even greater, by fear. And fear is a very, it's an emotional response. It's to anticipating what's going to happen. So it's very psychological, but it creates an asymmetric price risk. The behavior on price is asymmetric when we've got fear involved. It becomes very jittery. So the volatility it feeds a lot. Again, leading back to the need for working very closely with your suppliers and your customers to work symbiotically to create solutions. And this is another part of the, when we talk about risk management, we talk about the supply chain. I think hopefully COVID and the pandemic is forcing a move to evolve from transactional to solution-based mentality. And that means physical and financial woven in together. We need to work with suppliers, we need to work with consumers throughout that value chain to have the ecosystem survive this as best we can, keep people employed. And that's very important. So a lot of the time derivatives are looked at and risk management is looked at as risky. You hear the stories about traders on Wall Street, et cetera, and maybe some movies, et cetera. But I mean, at the end of the day, this is a tool. And it's a very important tool to develop your capabilities for, to be able to participate in moving again from transaction to solution orientation to help your customers. And that's what's going to be, I think, hopefully we've moved to an inflection point in the steel industry through this COVID crisis too, where that's recognized. And again, volatility is showing that that's what's required. And I don't see this fear going away anytime soon. I mean, we've got globalization, localization, we've got the green economy, we've got US election cycle. We're in the last stage. The current president. We've also got the trade war that's still kicking over as well. So we haven't seen the last of volatility. We get second waves of the pandemic, for example. So there's a huge amount to talk about here, but I think I'll leave it at that so we can get some time with the panel. But hopefully that gives you a bit of a taster.
Thank you so much, Mr. Glass. That was very enlightening. And so we'll open the floor to everyone for this question, because we are getting the same common question from a lot of people on current iron ore prices in China. So they're asking, are $125 to $135 per ton CFR level sustainable? And do you think local miners will ramp up the production if prices continue to stay at these levels? Hongwei, would you like to take this one?
Yes, sure. I will take this one on. I think there are a couple of reasons. Things, the market has been into the 8 months, almost 9 months of this year. I will not go to, retrospect what is going to happen. But for the next couple of months, to answer first, whether the China's domestic iron ore supply will be catching up with the pace, I would say no. Simply because, China has been producing as much as it's possible, because of the degrading, because of a lot of open pit mines going into underground. So it's unrealistic. China will not be able to produce that much, anymore, or kind of 2-digit increase is unlikely. But one of the things I think I need to highlight about the prices is not only about the supply, you have to look at the demand side, because this is a very interesting market, is that no one is having a dominant power, right? So if for the past 8 or 9 months, everyone looking at iron ore price thinking that, China like kind of a price taker, but really, come down, have a think. If Chinese steel mills are not making money, they will not take whatever price iron ore. So whatever they're paying, showing that they're still making money. And also, I think in one of the private questions I highlighted that is that for the Chinese steel mill, at different stages, you need to look at their strategy. Sometimes the tactic is for the productivity. So they are looking for higher grade, better, less impurity supplies, whereas elsewhere looking at lower grade. So, for the prices, do not get too excited. As Vicky shared, so far this year, overall supply is pretty, I wouldn't say, really growing much, but then it's rather stable. It's more about the market sentiment has been playing a very important role, and also China got a port congestion and everything. And the market, I have to say, iron ore supply market is highly concentrated. You got the top 4, accounting for almost 80% of China's supply. The rest actually are just supplementary to the market. So do watch out China's steel margins, and that would be telling you the real story whether the Chinese steel mills will be afford to pay. And don't worry about the supply. So long as you pay the right price, the supply will coming out from South Africa, from Mexico, from Norway, from Swiss, all the places. Yeah. So that is my question. That is my answer to the question. Yeah.
Thanks, Hongmei. So I will like to move on to Mr. Biao and ask him that we're seeing that China's steel production is likely to cross 1 billion tons in 2020, and that is the main theme of this webinar. So what do you think are the key drivers for this? Mr. Biao? Yes.
Okay, thank you. I think that Chinese steel output in this year may be over 1 billion tons. And as I said, that in the first 7 months of this year, the output rose by 2.8%. And I think that the key driver is the steel demand. The steel demand is very strong. So I think that in the second half of this year, the steel demand will be higher than the first half of this year, and especially in the construction, especially the steel demand from construction. I think that the infrastructure investment, the infrastructure demand, infrastructure investment will be rise by 5% to 10%, and so in the remaining 5 years, in the remaining 5 months, the investment will be very high. So I think that with the strong demand, and the Chinese steel production will be over 1 billion tons. That's what. Thank you.
Mr. Biao, there's a short to medium term outlook on Chinese steel prices, and our audiences would like to know what would be the major drivers influencing prices in coming months. Would you take this question?
Sorry.
So our audience would like to know that in Q2, what is the short to medium term outlook for Chinese steel prices, and what would be the major drivers influencing prices in the coming months?
In my opinion, the steel price will be kept stable in September and in October. How to say? In the 2 months, the steel demand will be kept at a high level. So I think that in the steel price will keep stable in these 2 months. But if the crude steel production keep high level in Q4, so maybe the price will drop down.
Mr. Glass, would you like to also give some inputs on this question?
Yeah, sure, thanks. I tend to agree. I think we're going to remain pretty stable this year. As Hong Mei was saying earlier too, this is a year of policy. China has, I mean, in light of all what's going on in the globe as well, and with the trade war, etc., I think China policy is clearly favouring expansion. We also see that reflected if we just look at anecdotal evidence in pricing, right? We see a lot of demand for sintering product. We've seen the prices for lump next to almost zero, lowest they've ever been. I even got asked the question if they could go negative. There's been a talk about crushing lump, for example. Now, sintering obviously is a pretty dirty practice. And even, I mean, lump for arguably direct injection, if you're going for sintering like that, it's clearly policy driven on focusing on production. And again, so I don't think that's going to go away in pricing this year. The other thing too is the fear over Brazil was a big pricer for the 65 premium. 65 premium is still pretty robust. The amazing part about that is it's actually when the underlying price is in backwardation, the 65 premium is in contango. So that was telling you that actually there is still a significant amount of concern on supply of seaborne high-grade product. And again, that's fear-driven, right, in a lot of ways. So expect that to continue. 2021, though, I would expect to see an evolution as we move back to a conversation and a focus on the environmental policies in China. Once the economy is ticking away again, people are re-employed, money's being spent, auto sales are looking good, they're stable. I do think that we're going to see a focus back on that, at which point I think lower grade will suffer a little bit. I think we'll move into that high grade demand will remain there, and some of the pricing on the high grade premium at the moment may be reflecting that. Some people expect it sooner rather than later. Rest of the world is going to pull on demand as well as their steel mills come back. I think governments are going to support, whether in Europe, for example, steel milling was on the nose. From an environmental perspective, I think they're realizing they don't want to rely on Chinese steel exclusively and have those industries die domestically. So expect that to be supported. But environmental concerns will, I think, push more towards the high grade, and we can see the price probably drift off a little bit. But demand is going to remain very robust until the end of this year. So 120 bucks on 62, I don't have a problem with. Do we go to 150? I don't think so. Do we drift a little bit lower? I still think we remain with three figures, right?
Shreya, can I just add on one more point?
Yes. Oh my God.
I'm just thinking that the market getting a bit too excited when you're talking about steel prices. Everyone needs to calm down, compare with last year. Even though this year it seems that not as bad as expected, but even like for China's steel prices, doing a comparison, you'll be able to see that the rebar and the HRC prices were far lower than last year, which means that the steel mills are really a very precarious situation. The iron ore prices definitely higher, may not be too high from last year, because last year you got the Valley as well, right? So the Valley pushing up the prices, the incident, I'm not saying Valley, sorry. So the Valley incident pushing up the prices, and this year, because of all kinds of reasons, the iron ore prices remaining high, but the steel prices have been squeezed. It's not really as bad as it is, but it's not as good as last year. So I think everyone needs to calm down, think about the situation. This is one of the things I want to remind everyone. Rebar prices, for example, compared with last year around the same time, Chinese rebar prices is at least 200 RMB lower. Looking at the inventories, rebar and HRC inventories in general are 20-30% higher than the same time last year. So there are some risky situations brewing in the background. It's just that when it will come up. But luckily, because of the demand has been supporting it. So that's the situation, I think, one of the things.
Thank you, Hong Mei. Thank you, Mr. Klaus. Thank you,
So
Mr.
can I just add one more thing there, sorry, which I missed before. There's also issues around the US dollar weakening.
Okay.
Because picking up a product which is denominated in US dollars now, and you're expecting it to weaken, all things remaining equal, if the US dollar continues to weaken, you could see a $120 product coming to $130, for example, in US dollar terms, but it's not changing your domestic currency terms as well. So FX is an important thing to keep in mind here as well. Sorry, I just want to add that on as well.
Okay, thank you so much. So we'll take one question from the audience for Ms. Madhumita. They're asking, how are iron ore fine prices increasing so rapidly? And they're also worried about the poor supply of iron ore fines from mines in Orissa, India. What are your suggestions to increase supplies?
Yeah, I'll just club both the questions and give sort of an answer. Prices are climbing up at a time when supply tightness is there from Orissa, with just about 5 mines out of the 9 auctioned in January and February this year having started operations. And we also heard that the mines have started operations but are producing at a very low key, and that too mainly for captive use. So, I mean, therefore, while there is an uptick in domestic demand, there is supply shortage, no doubt, especially for lumps from Orissa, which is the largest iron producer in India, producing state in India. So, stocks from erstwhile lessees that are expected to be consumed by September 2020 are reportedly getting released slowly into the market. And another option for raising supplies could be, cutting down on pellets exports over a short term to tide over the crisis.
Okay.
That's what I feel.
Okay. Thank you, Ms. Madhvita. So moving on, I'll throw next question to Mr. Biao. We are seeing that the COVID-19 pandemic is nudging these Chinese steel makers toward more, using more of electric arc furnaces to produce steel. Do you agree that this should be happening? And if so, what would be the timeline would look like, and what can be the obstacles that they face?
As we all know that the crude steel output from EAF in China is about accounting for 10%, and we know that the number is improving in the recent years, and we also can see that the key point is that if Chinese steel makers will use more EAF, that's dependent on the electricity charge and also scrap prices. And now we can in last year China used about 200 million tons of scraps, and I can see and I think that the EAF will be a trend in the near 10 years. So, but now the key point is that we must have the good scrap recycling system, and also we must have the more electricity charge, and maybe the crude steel outputs from EAF will be rise in the next 10 years. Yes.
Shreya, can I just come in to add one more point to my answer? I want to add that OMC has been given a clearance, to start mining, and is very close to, getting the EC clearance for one of its mines, and will start mining shortly. And this can assuage some of the supply constraints going forward. Not immediately, but over the next, say, few months.
So my next question is for Mr. Andrew Glass, and please bear in mind that we are running really short on time, so I'm just going to make it really quick for this panel. Maybe one more question after this one. So Mr. Glass, China has an active rebar and HRC futures contracts with Shanghai Futures Exchange. Most of the prices are determined from these contracts itself. So how do you think someone who's outside China can hedge on these prices? Could you share?
Yeah, sure. Thanks. Well, I think the new contract that's available on the LME is a China steel contract. I'd suggest that's probably the lowest hanging fruit to go and operate there. You don't need to have an onshore company in China or any of the other stuff. You can set up an account through a clearer or do it OTC through a bank, and you can get access to that. It's fully it's transparent. You can see the end of day prices and everything. So I'd suggest that's probably the lowest hanging fruit there. SGX also offers a steel contract, varying degree of liquidity, slightly different on delivery mechanism, or sorry, the settlement mechanism. So just look into that, what suits your risk management profile the best. But I'd suggest they're probably the easiest because they're also US dollar denominated. It's a global market. And like I said, the funds and stuff are starting looking at those ones as well. So liquidity is building significantly, which is great news. So I'd go for those ones.
Okay. So there was one follow-up question that I wanted to ask, but I refrained from asking. But I wanted to throw this question to Mr. Glass and Hong Mei. Do you think that the shift from the Australian supply to other alternatives indicate that China is building up for a parallel supply chain for iron ore?
Okay, Andrew, please just go ahead first, and then I'll just add on whatever you miss.
Okay, no worries. You can correct me too. Look, I mean, I think it makes sense, right? I mean, we see saber rattling between Australia within in light of the trade war as well. Australia has a what we call a liberal government, but it's more right-wing government, I suppose, in the Liberal Party, and they're clearly backing US in the trade war. There's a lot of other issues there. China's already created issues with barley out of Australia, wine out of Australia. So, it just makes sense, frankly. I mean, anyone runs any business. You don't want to have your supply chain beholden to only a couple of suppliers. You want to diversify as much as you can. So issues around Simandou and some of the other opportunities China's got to develop alternatives, I think makes complete sense.
Yeah, I think from my point of view, I think it will be ideal world if you can just giving yourself more alternatives. But sadly, I would say that for the time being, it's simply not possible. Like, Australia actually taking care of almost at 60% and plus China's iron ore imports. You want to shift the focus, but it won't be happening overnight. Just now, Andrew mentioned the Simandou. The Simandou project actually has been into discussion for quite some years, and then still on the ground, not taking off yet. But then it has recorded, attention from the Chinese companies, which means that the Chinese steel mills and the companies are looking for alternatives. But in order to, really substitute the Australian iron ore supply, I don't think it will be feasible in the next 3-5 years, or even like longer term, it could be 10 years. And also, I think another thing is that I try to stay away from politics, by the way. If you look at Australia, looking at BHP, looking at Rio Tinto, looking at FMG, they have been super friendly to China. So at the end of the day, even you have a very solid political relationship, doesn't mean that your companies will be acting accordingly, especially your 80% majority share is about China. I think many of the companies will rethink about that thing. And don't forget that Rio Tinto, especially Rio Tinto, FMG, and BHP as well, have been upgrading and expanding or replacing their old mining assets in order to, having the sustainable supply to the market. And if you're looking at the market, China definitely the primary target. So they already put the money in, and then I don't think it will be just cut it off anytime. It's simply unrealistic. Yeah, that's my answer. Thank you.
Okay. So my last question would be for Mr. Biao. Mr. Biao, China has turned a net importer of steel after 2009. Could you share with us what is changing these dynamics?
Okay. Yes, in this year, China has turned a net importer of steel in June and in July, but that's because that's mainly about we import mining unit and mining HRC, and we can see that in 2009, China also had turned that importer in some months of that year, and I don't think that it will last long in this year, and I think that the key reason is not the demand, the steel demand difference between China and the world. We can see that in Q2, China's steel demand is very strong, and the steel demand in the world is very weak. So the steel price in China is higher than the price of the world. So they will China import some steel or many steel in the near months, maybe in June and in July. But I don't think that it will last long. And at the same time, as we know that with the steel demand of the world improve, and I think that the steel import will be dropped. That's all.
Okay, thank you, Mr. Biao. So that looks like we have run out of time. In fact, we have run mostly over time limit. So I do see that we had a really good discussion, and it was very active and lively panel discussion, and we got a bit more clear picture behind what is behind China's rapid increase. We do apologize that we couldn't take too many questions from the audience. We try to squeeze in as much as we can from your end and our end as well. And lastly, I would like to ask each one of our panelists to see if any of you would like to add anything else before we wrap up for today. Would any of you would like to add anything?
You want to call the name one by one? Can I just add one more point about Mr. Liu comment about imports? I think do bear in mind, normally whatever arrived in China was booked 2 months or at least 1 month ago. So whatever arrived in China, July most probably came from the deal signed in May. But do watch out for July. July, whatever deal signed in July will be arriving in September. May not be that bad, but October will be tricky because starting July, global prices have been on the rise, which means that China has been booking a lot less steel from the world market. And so September, October, there could be a turning point coming over. And also the net imports, is just 2 months anyway. China is a trading hub, so they will be checking out the prices and making the best decision ever. And I think that is what from me. And then Shreya, can I just make a suggestion, because I can see a lot of questions. Yeah. And then if you can, you definitely can compile the questions in an Excel file and send it to us. And then at least I will try my best to take on the questions. Yeah, yes. That's all from me. Thank you.
No problem.
Thanks everyone. Thanks.
Great, that's all for today, everyone. Thank you so much for being here. We appreciate you being here really, really well. Thank you so much to our esteemed panelists for joining us today. Do stay tuned to Steelmint Events for the latest webinars, podcasts, and blogs. And we will see you next time. Thank you. Bye-bye.
Thank you.